In this video, I have the 5 best trend following indicator signals for you, and number 2 and number 4 are my absolute favorite. Let's get going with the moving average channel. I made videos about this, but this is one of the most powerful signals. This is a moving average channel which is both using a 20 period EMA, and when you open the settings, one you change to the high and one you change to the source low, and then you get this beautiful channel. And what you will see is that during a trending market like here on the left, the market is trading below the channel. Then you have the corrective phase where the market trades back inside of the channel and sometimes even on the opposite side. Then you wait for the market to clear the low. In this case, we have a beautiful consolidation pattern. We take out here the trend line, continue on the downside below the channel. Then we have the next consolidation. On the breakout, the market is continuing on the way down. How do you use the channel? First of all, you can use it to understand the trend direction. Where's the market trending, on the upper side or on the downside? And you can also use it to trail your stop loss along the moving average channel. Here another example. The market was here in an accumulation. We had the breakout. We started the first continuation here and the first impulsive wave. We have a little bit of a pullback inside of the moving average channel. And if the market now resumes to the upside, this is a continuation signal. The market is an overall uptrend already. We have to push inside of the channel and then the rejection. This is the channel rejection signal. Then you can see the market trades above the moving average channel and continues the uptrend. You could have traded your stop loss along the moving average here to secure your profits and then ride the trend. Stochastic riding is something that often blows people's minds because it shows you how to use the stochastic in a real way. One tip, I use the stochastic on the 1 hour, but when you open the settings on the stochastic, I set the time frame to 4 hours. And what this does is that it gives me here the stochastic from the 4-hour time frame, but as you can see, we are on the 1-hour time frame, and here's where we look for signals. And what you want to see is that first of all, you want to wait for the market to break out of a sideways consolidation like it did here. And then when the indicator is entering above 80, what some traders will call overbought, they believe that the market is going to reverse. However, if you truly study the stochastic indicator, you will see that it's a momentum strength indicator. And the higher the stochastic is, the stronger the trending market is and the stronger the trending price action is. So instead of going against the stochastic, what you should be doing in reality is go with the stochastic. So when you see that the stochastic enters above 80, this is a trend continuation signal. And you can see that here on the breakout, we have the retest and then the uptrend unfolds and the stochastic stays above 80 all the way until we enter here this longer than usual sideways phase and we see a little bit more selling. And then you can see the stochastic goes back below 80 and this could have been used as an exit signal. So this is really important. The stochastic is a momentum and a trend following strength indicator. And when it's above 80, it shows you a strong trending market to the upside. When it's below 20, it shows you a strong trending market to the downside. It is not overbought and oversold, which means that you should go against the stochastic. Here another example. We were in this uptrend. Then during the consolidation, the stochastic dipped below 80 a little bit. It failed to reach 20, so it shows you that the stochastic didn't detect a strong downtrending move. And now we have the inverse head and shoulder. We have the pressure buildup, the breakout buildup. We get above here the resistance and the stochastic gets above 80. This is a trend continuation signal. And then you can see the trend unfolded and the indicator, the stochastic, stays above 80 until here we have a stronger than usual dip. And you can see the stochastic indicator is actually a great trend following tool. Let's take a look at another example. The market after our inverse head and shoulder, it rallied higher. We had a little bit of a dip. Although it looks strong, the indicator shows you that it barely hit the 50 level on the indicator. So this is a great way to have objective analysis. Then you can see the market rallies back into the trend line. We have the breakout. The breakout occurs as the indicator gets above 80, gives you another trend following signal. And then as the price unfolds here to the upside, the indicator stays above 80. So if you're looking for a trend following confirmation tool that you can use to analyze trends objectively, and if you've been struggling maybe even with confidence in your trend following trades, then the stochastic is such a great tool to use. The MACD is also a popular signal and a popular indicator used for trend following trading. And in this downtrend, what you will often see is that when we connect the highs of the MACD histogram, is that it confirms the trend direction. A lot of traders, and I've worked with many traders over the years, they get easily scared out of their positions when they see a corrective wave. So for example, let's assume you're here in a downtrend, you have been trading short this market, and then you are encountering those sideways and those correction phases, a lot of traders will exit their trades way too early. However, looking at the MACD and seeing that each high of the MACD is lower than the one before, it actually confirms that there is more bearishness in the market. We can also take a look at the lows here of the MACD, and you can see that the lows are lower than the one before, confirming the ongoing trend direction as well. So looking at the MACD in that way can help you confirm trends and stay in trends. However, there's another way of using the indicator and the MACD. Here you can see during the uptrend, the MACD gave you higher highs and the price action was a green. It's also moving higher with higher highs. Then something is changing. From here to here, the MACD suddenly started to show you lower highs. Why is this? The MACD is a strength and momentum indicator. And when the MACD is going down, it tells us that there's not a lot of strength anymore in the market. And we can see that from the price action. Here in the first part, there was a lot of strength in the market, and the market moved higher with a lot of force and with a lot of momentum. But here at the top, you can see the market didn't move higher a lot. It barely was able to break above the candlestick wick here. Also, it took the market quite a long time here to get to that. And this is what the indicator is picking up. The indicator is picking up weakness in the price action. What you should be doing when you see the divergence is not just straight away jump into a reversal trade, but what you should be doing is look at the lows of the market. In the case of an uptrend, you can see we have one low here, we have one low here, and then here is the highest low that we are seeing. We draw a support level here, and what we do is we wait for the market to take out the low. In the case of an uptrend, you want to be careful with reversal trades. You want to make sure that the market is actually able to take out a previous low. And then this is the signal that the market has a higher chance of continuing on the downtrend. This happened here. We have the lower bounce. This is a breakout buildup. We trade here below this area. We have a strong breakout candle taking out the previous lows. And this then can signal a start of a new downtrend, as it did here in this case. The Donchian Channel is a great tool for breakout traders or people who want to trade fakeouts. What we have here is the daily Donchian Channel on the 1 hour. So I'm on the 1 hour time frame. And if you add the Donchian Channel to your charts, you open the settings and then under time frames, you set it to 1 day to daily time frame. And then what you see is that when the market is hitting the Donchian Channel in a range market, you will often see rejections. Trading outside of a Donchian Channel is not super common. And especially if you can identify on the higher time frames a long-term range, you want to pay close attention to how the market is trading into the outer side of the Donchian Channel. You want to look for weakness, you want to look for exhaustions. You can look, for example, for break and retest, such in this case, we have the resistance, then we break out, test it as support, shoot higher. Here we have weakness as well. The market hits the opposite side of the Donchian Channel, it trades lower, fails to reach the high, and then sells off. And then the same repeats itself over and over again. However, the Donchian Channel can also be used for breakout and continuation trading. What we have here is a strong trending market. The market puts in this high, which is then used here for the Donchian Channel as the new high. And then what we are doing is we want to see the market clear the high. We can see we had a very weak correction phase. The market tried to sell off, but the market was not really successful and the market didn't sell off a lot. And then what we do is we wait for the breakout, we have the retest, and then we see the acceleration away from the level. My tip for trading breakouts is don't try to trade the immediate breakout. Wait for the market to pull back into the breakout level and then see the reaction. In this case, you can see the market is reacting and accelerating away from the level. So this looks like a successful retest. And then we trade continuations here. And then you can see the market stays very close to the outer Donchian Channel, confirming the uptrend. So in this case, you can see the market was in an uptrend. We saw the weak correction. We waited for the breakout. We want to see that the retest is succeeding. And then you can see you trade the continuation. Here, another example. The market is in an uptrend. The market was already able to trade here outside of the Donchian Channel, which is a good sign because it shows you that the market is already in a trending mode. Then we have here a new high, the market sells off, comes back, takes out the previous highs, pushes higher the Donchian Channel, and then you can see after this, you can see the market trades higher and higher around the outer Donchian Channel. This is a super strong signal of a trending market, especially when we see the context of the market already being able to trade outside of the Donchian Channel. When you can see that previously the market is already able to trade outside of the Donchian Channel, that's a really great signal for a strong ongoing trend. And then we're going to look at the moving average Alligator system. This is a moving average system that uses 3 different moving averages. I'm using the 10 period, the 30 and the 50 period moving average. You can use EMAs or SMAs, doesn't really matter. What you will see is that in an uptrend, you will see that the moving averages separate. The 10 period is above the 30 and that's above the 50. So this is a bullish structure. When the moving averages change the structure, and now you can see the 10 is at the lowest, the 30 in the middle, and the 50 at the highest, this is a bearish trend structure. What you then do is you wait for the impulsive wave to fade, and then you can see you get a retest of the moving average channel. In this case, we get a retest of the 50 period, and then we pull back outside of the moving average channel, and also we take out the previous low. That's a continuation signal as we've seen here, and then the market moves all the way outside of the 10 period EMA. We briefly dip back into the 10 EMA and then continue lower. You can see this was the dip into the 10 period. We accelerate away and then you continue outside. When the market is able to stay below the 10 period and the 30 period, that's a really strong bearish signal. If you see that the market is able to get above the 30, then watch how the market is reacting to the 50. When the market is below the 30 and the 50, I would be a little bit cautious and I would not get into new positions, because at that point the market could also break to the opposite side. But if you see, like in this case, the market reaches the 50 and then rejects it very strongly and continues, that's a good continuation signal. Here another example. On the left we have the bullish trend structure where the 10 is above the 30 and above the 50, and this changes then during the distribution, a long-term sideways phase. This changes, the moving averages are crossing each other and are top of each other. During sideways periods, you generally don't want to use moving averages because moving averages are only used during trends. We have the breakout, we get the liquidity run here, and then the continuation. This is your first entry signal. The moving averages are also separated nicely, 10, 30, 50. This is the bearish structure that we're looking for. And then you can see the market sells off below the 10. We have a dip in the 30 period moving average and then the continuation signal where we reject the middle. We're not even able to come close to the 50. So this is showing us a healthy downtrend. And then you can see we move lower. We sometimes dip into the 10, but we don't even reach the 30, let alone the 50.